Ladies and gentlemen, it is 11:47 post-meridian Eastern Standard Time on January 11th, 2026. We are exactly 36 hours away from a monetary event that will rewrite the global financial order. My name is Marcus Kane, known to many of you as the Market Reaper, and what I am about to show you is not speculation. It is not theory. It is mathematical certainty unfolding in real time while the world sleeps. Right now, at this very moment, there are three different prices for the United States dollar. Not one price, three prices. The screen you're watching on Bloomberg Terminal shows you one number. The currency exchange booth at the airport shows you another number. And the price that central banks are paying each other in private settlement operations shows you a third number that is so far divorced from the other two that the entire concept of a unified dollar has ceased to exist. The fracture has occurred. The split is complete. We are watching the United States dollar bifurcate into separate instruments trading in separate realities. For 40 years, we lived in a world where $1 equaled $1 no matter where you were standing. That world ended 72 hours ago. You just do not know it yet because the screens have not updated. The tickers have not caught up. The talking heads on financial television are still reading from scripts written in a reality that no longer exists. But the smart money knows. The sovereign wealth funds know. The central banks know. And now you're going to know. This is not a market correction. This is not a policy adjustment. This is not a temporary dislocation. This is the complete and total breakdown of the pricing mechanism for the world's reserve currency. When the same financial instrument trades at three wildly different prices simultaneously, and when arbitrage fails to close that gap, you are not looking at a market anymore. You're looking at a market that has died and is waiting for someone to announce the time of death. The era of a unified dollar ends tonight. The era of fractured dollar realities begins Monday morning. The 36-hour countdown is running. Let me show you the three levels of reality that now exist, and then you will understand why every second between now and Monday morning is a second closer to the greatest wealth transfer in human history. At the interbank settlement market in Hong Kong, the United States dollar closed its Friday session trading at a rate of 0.78 Hong Kong dollars per one United States dollar. Let me say that again because this number matters. 0.78. Now you might think that sounds normal until I tell you what happened. Major multinational corporations with operations in Asia, specifically semiconductor manufacturers and pharmaceutical companies, paid premiums of up to 15% above the quoted spot rate to secure immediate dollar settlement for their supply chain payments. 15% premium. That means they effectively paid at a rate equivalent to 0.66 Hong Kong dollars per United States dollar to guarantee they actually received the dollars they needed. Why would Samsung pay 15% extra for United States dollars? Why would Taiwan Semiconductor Manufacturing Company pay 12% over spot? Because they have supplier invoices due Monday morning denominated in United States dollars, and they can see what you cannot see yet. They can see that the settlement system is fracturing. They can see that the theoretical price on the screen and the actual price of securing physical dollar settlement have completely separated. These are not speculators. These are treasurers of multi-billion-dollar corporations who understand that the cost of paying 15% extra for dollars today is microscopic compared to the cost of failing to make payroll or defaulting on supplier contracts Monday morning. This is the price of the real world. This is the price of panic. This is the price that entities who absolutely must have dollars right now, not tomorrow, not next week, but right now, are willing to pay. And it is 15% higher than the number flashing on your screen. In Dubai, at the currency exchange windows that handle large commercial transactions for oil traders and commodity merchants, the United States dollar is trading at an effective rate approximately 9% weaker than the official spot market rate. These are not retail transactions. These are million-dollar-plus conversions happening between entities that need physical dollar delivery, actual movement of settlement balances, not paper promises. The premium here is smaller than Hong Kong because Dubai dealers have slightly better access to New York settlement windows. But make no mistake, 9% is still an enormous dislocation. In London, at the private banking windows that serve as hedge funds and family offices, dollar purchases for immediate settlement carry a 7% premium over the official spot rate. Again, this is not the spread you see on your Forex trading platform. This is the actual cost of securing real, deliverable, settled United States dollars that will clear through the Federal Reserve payment system. This is the honest physical market. This is what dollars actually cost when you need them delivered and settled. This is the market that exists outside the screen, in the real world where money must actually move from one account to another with finality. And then we have the New York spot Forex market, the Intercontinental Exchange, the screens, the tickers, the official rate sitting at approximately 100 on the dollar index, which measures the dollar against a basket of major currencies. This is the price that financial media reports. This is the price that appears on your trading platform. This is the price that central banks officially quote. And this is the price that has absolutely no connection to reality anymore. Let me show you the mathematics of the impossible. If the Hong Kong interbank market is effectively paying 15% more for dollars than the New York spot market quote, that creates a price differential that should not exist for more than seconds. Here is why. Let's do the calculation step by step. Suppose the official spot rate says $1 equals 6.5 Chinese yuan. But buyers in Hong Kong are paying premiums that effectively make them pay 7.5 yuan for that same dollar. The spread is 1 full yuan per dollar. Now multiply that by a transaction size of $10 million. That is a 10 million yuan profit opportunity for anyone who can buy dollars in New York at the official rate and sell them in Hong Kong at the panic rate. 10 million yuan is approximately 1.4 million United States dollars of pure arbitrage profit on a single $10 million transaction. Arbitrage traders exist specifically to exploit exactly these kinds of price gaps. When gold trades for $3 more in London than New York, arbitrage traders instantly buy in New York and sell in London until the prices converge. When oil trades for $2 more in Singapore than Houston, arbitrage traders ship oil from Houston to Singapore until the spread closes. This is how markets work. This is how prices stay synchronized across geography. But this is not happening with the dollar. The spread is not closing. It is widening. Why? Because the bridge is burned. Because arbitrage is dead. Because currency controls and settlement restrictions have made it functionally impossible to move large amounts of dollars from the New York paper market to the Hong Kong physical settlement market fast enough to capture the spread. The Chinese authorities have implemented layered foreign exchange controls that require multi-day approval processes for large dollar transactions. By the time your arbitrage trade clears the approval process, the spread has moved and your profit has vanished. Or worse, new restrictions have been implemented and your dollars are trapped. The New York market has become an island. It is a paper market trading paper promises of dollars that may or may not actually settle. It is a screen that shows you a number that represents nothing except the collective hallucination of algorithmic trading programs bouncing prices back and forth between each other. It is a zombie market. The body is still moving, but the soul has departed. The price flickers and changes, but it has lost all connection to the actual cost of securing settled dollar balances in the real global economy. I need you to understand this point because everything else flows from it. In a functioning market, arbitrage is the force that keeps prices synchronized. If wheat trades for $8 in Chicago and $9 in Paris, farmers ship wheat from Chicago to Paris until the prices equilibrate. But what happens when shipping wheat from Chicago to Paris becomes legally restricted? What happens when you need government approval that takes 3 weeks to get? What happens when the government says you can only ship 1 truckload per month? The prices stop converging. The market split. Chicago wheat and Paris wheat become 2 different commodities with 2 different prices, even though chemically they are identical. That is what has happened to the United States dollar in the last 72 hours. New York dollars and Hong Kong dollars are technically the same currency, but they are now trading as if they are different instruments because the mechanism that would normally force the prices together, which is arbitrage, which is the instantaneous flow of capital from cheap markets to expensive markets, has been severed. The bridge is gone. The circuit is broken. And when arbitrage dies, unified pricing dies with it. What you're left with is exactly what we have right now. 3 separate markets, 3 separate prices, and a complete breakdown of the concept that $1 equals $1. Let me take you back 72 hours. On Thursday morning, January 8th, the Federal Reserve released its routine data on same-day settlement requests through the FedWire system. The number for Wednesday, January 7th, was utterly unremarkable. Approximately $400 billion in same-day settlement requests, which is completely normal for a typical business day in the global financial system. Banks settling transactions with each other. Corporations paying suppliers. Investment funds moving money between accounts. Nothing unusual. Nothing alarming. Just a routine flow of the world's reserve currency doing what it does every single day. Financial commentators looked at that number and laughed. They said, "See, everything is fine. The dollar is liquid. The system is functioning." Anyone who claims there is stress in dollar markets is a conspiracy theorist peddling doom. I remember reading those articles Thursday afternoon. I remember the smug confidence of analysts who thought that $400 billion in settlement requests proved the system was healthy. Then Friday's data came out. Settlement requests for Thursday, January 9th, $1,200 billion. Let me repeat that number because your brain might not have processed it correctly. $1,200 billion. In a single day. Let me show you the mathematics of this explosion, because numbers this large become abstract if we do not break them down. Wednesday's settlement requests, $400 billion. Thursday's settlement requests, $1,200 billion. The increase, $800 billion. Now, let us calculate the multiple. $1,200 billion divided by $400 billion equals 3. This is a 300% increase in 24 hours. This is not a surge. This is not a spike. This is a stampede. This is a bank run happening in slow motion in the institutional settlement system. $800 billion in additional settlement demand appeared out of nowhere overnight. To put that in perspective, $800 billion is larger than the entire annual gross domestic product of Switzerland. It is larger than the market capitalization of Apple and Microsoft combined. It is an amount of money so vast that it represents approximately 4% of total United States annual economic output, and it all suddenly demanded same-day settlement in a single 24-hour period. This is not increased business activity. Companies do not suddenly need 3 times more same-day dollar settlements because business picked up. This is not trade. This is not commerce. This is fear. This is panic. This is counterparty risk exploding into the open. When settlement requests triple overnight, what you are seeing is a collapse in trust. Banks that were perfectly happy accepting payment promises yesterday are demanding immediate settlement today. Why? Because they no longer trust that the promises will be kept. Because they can see what is coming. Because they know that by Monday morning, the entity that owes them money might not be able to deliver. Think about what an $800 billion settlement demand spike represents at the micro level. That is $800 billion in transactions where one party said to the other, "I know we usually settle this at the end of the week, but I need my dollars right now, today, immediately wired to my account with Federal Reserve finality." Why would they do that? Why would a bank or a corporation or an investment fund suddenly insist on immediate settlement when they have been accepting 2-day or 3-day settlement for decades? Because they fear that if they wait, the dollars will not come. Because they fear that settlement rules might change. Because they fear that their counterparty might fail between now and Monday. Here is what is actually happening beneath the surface, and this is the part that should terrify you. For the last 18 months, major global banks have been running short positions on the United States dollar in the forward currency markets. A short position means they have sold dollars they do not currently own, betting that the dollar will weaken so they can buy it back cheaper later and pocket the profit. This is a routine strategy that banks use for currency trading and corporate hedging. Under normal circumstances, it is a perfectly safe trade because dollars are liquid. If you need to buy dollars to cover your short position, you just go to the spot market and buy them. Easy. Simple. done 1,000 times a day. But what happens when the entity on the other side of your forward contract suddenly demands physical settlement? What happens when they say, I do not want to roll this contract forward, I want my dollars now, today, delivered and settled? Now, the bank has a problem. They're short dollars. They sold dollars they do not own. And now they need to go find those dollars in the market and deliver them immediately. What do you find? $800 billion on short notice. You go to the spot market. You start buying. But here's the problem. When everyone tries to do this at once, the spot market price starts rising fast. And the more it rises, the more money the banks lose on every dollar they have to buy to cover their short positions. They sold dollars at 100 on the dollar index, expecting to buy them back at 98. But now they are having to buy them at 102 or 105. And every point higher is billions in losses. This is what is driving the explosion in settlement demands. This is why we went from 400 billion to 1,200 billion overnight. The shorts are being squeezed. The banks are scrambling. They are running to the Federal Reserve's settlement system, demanding immediate dollar delivery because they made promises they now have to keep, and the dollars they thought would be easy to obtain have suddenly become expensive and scarce. This settlement surge is the mechanism that breaks the bank. When you're forced to buy dollars at elevated prices to satisfy settlement demands that are 3 times normal volume, your liquidity evaporates instantly. Your carefully constructed balance sheet that showed you had adequate reserves to cover normal operations is suddenly underwater because operations are no longer normal. You budgeted for 400 billion in daily settlement flow. You now have 1,200 billion in settlement demands hitting your desk. Where does the extra 800 billion come from? It comes from emergency borrowing. It comes from liquidating other positions at fire sale prices. It comes from calling the Federal Reserve and begging for help. And that is exactly what we have seen happen over the last 48 hours, which brings us to the most terrifying data point of this entire crisis. If Thursday's $800 billion settlement surge was the warning shot, Friday's Federal Reserve response was the signal of distress. The bleeding did not stop. It accelerated. And the emergency measures deployed to contain it have now reached a scale that proves this is not a technical glitch or a temporary liquidity squeeze. This is a solvency crisis at the core of the global banking system. On Friday, January 10th, the Federal Reserve conducted what it quietly described in its official release as routine reserve management operations. The language was deliberately boring. The tone was deliberately calm. But the numbers told a very different story. The Federal Reserve injected $40 billion in overnight liquidity through its standing repo facility. $40 billion. Let me put that in context by adding it to the emergency liquidity that was deployed earlier in the week. On Wednesday, January 8th, the standing repo facility showed a balance of $75 billion, which represented emergency borrowing by major banks on December 31st to cover year-end liquidity stress. That $75 billion was supposed to be temporary. It was supposed to unwind after the new year began. And for a moment it did. By Thursday, it had dropped to zero. Crisis over, right? Wrong. By Friday, it exploded back to $40 billion. So let us do the mathematics. $75 billion Wednesday. Zero Thursday. $40 billion Friday. The total liquidity injected over this critical period. $115 billion in emergency overnight borrowing. But that is not the complete picture. We also need to account for the reserve management purchases, which is a separate program where the Federal Reserve buys Treasury securities from banks to provide them with immediate cash. The Federal Reserve announced in December that reserve management purchases for the period from December 12th through January 12th would total $40 billion. So now we add $115 billion from the standing repo facility plus $40 billion from reserve management purchases equals $155 billion. $155 billion in emergency liquidity deployed in less than 2 weeks. Let me say that number again slowly so it sinks in. $155 billion. That is the amount of cash the Federal Reserve has been forced to provide to keep the banking system liquid enough to function through the end of 2025 and the beginning of 2026. To understand the magnitude of this intervention, you need context. $155 billion is more than the entire market capitalization of Goldman Sachs. It is more than the annual defense budget of most developed nations. It is more than enough money to buy every ounce of gold held in Fort Knox at current prices. And the banks burned through this amount in 12 days simply to remain operational. This is not money being used to expand lending. This is not money being used to finance economic growth. This is money being used to plug holes. This is money being used to prevent collapse. The Federal Reserve is the emergency room surgeon trying to stop the bleeding, and the patient keeps bleeding faster than the transfusions can replace the lost blood. Let me walk you through the mechanical process of why major banks need $155 billion in emergency liquidity. Remember the settlement surge we discussed? The $1.2 trillion spike in same-day settlement demands? Every one of those settlement demands requires actual dollars. Not promises, not IOUs, actual settled balances in accounts at the Federal Reserve. When a bank receives a settlement request, it has three options. Option A, use dollars from its own reserve account at the Federal Reserve. But if hundreds of billions in settlement requests are hitting simultaneously, the reserve account empties fast. Too fast. Option B, borrow dollars from other banks in the overnight lending market. But here is the problem. If everyone needs dollars at the same time, there are no lenders. Everyone is a borrower. The overnight lending market seizes up because there is no supply. The rate spikes to 4% or higher, which is what we saw on December 31st when the standing repo facility balance hit $75 billion. Banks were so desperate for overnight dollars that they paid premium rates just to avoid settlement failures. Option C, go to the Federal Reserve's emergency lending facilities and borrow directly from the central bank. This is the option of last resort. This is what you do when the private market has failed and you have nowhere else to turn. This is what the standing repo facility exists for. It is the Federal Reserve saying, we will lend you dollars at a penalty rate to prevent your settlement systems from collapsing. The fact that banks borrowed $40 billion on Friday, after already borrowing $75 billion earlier in the week, tells you that option A and option B both failed. Their own reserves, insufficient. The private overnight market, frozen. So they ran to the Federal Reserve. They had no choice. But borrowing dollars to satisfy settlement demands is just plugging one hole. It creates another problem, leverage. When you borrow $40 billion overnight, you have to pay it back the next day plus interest, which means tomorrow you need $40 billion plus interest. If settlement stress continues, and all evidence suggests it will, you will need to borrow again tomorrow, and the day after, and the day after that. This is how liquidity spirals become death spirals. You borrow to survive today, which makes tomorrow harder, which forces you to borrow more tomorrow, which makes the next day impossible. The Federal Reserve can see this dynamic unfolding. They can see that the banks are trapped in a loop where emergency borrowing is not solving the problem. It is just deferring the problem by 24 hours. That is why the Reserve Management Purchases Program exists. It is a way for the Federal Reserve to inject permanent liquidity, not overnight liquidity, into the banking system by buying Treasury securities that banks hold. When the Federal Reserve buys $40 billion in treasuries from banks, those banks receive $40 billion in cash that does not have to be paid back tomorrow. It is permanent liquidity. It is a permanent expansion of the Federal Reserve's balance sheet. It is, to use the word everyone avoids, but everyone understands, a bailout. We are receiving reports from sources inside major financial institutions that paint a clearer picture of which banks are under the most acute stress. While official disclosures are minimal due to regulatory sensitivity, market intelligence suggests the pressure is concentrated in three areas. First, banks with large foreign exchange derivative books. These are institutions that sold dollar strength through forward contracts and options, expecting the dollar to weaken throughout 2026. When the spot dollar market showed weakness in late 2025, dropping 9.3% over the year, these trades looked brilliant. But then the panic premium emerged in Asian settlement markets. Suddenly, clients are exercising contracts demanding physical dollar delivery at rates that are now below market. The banks are forced to buy dollars at elevated prices to satisfy contracts they sold at lower prices. The losses are mounting. We are hearing whispers of mid-tier institutions reserving hundreds of millions for foreign exchange trading losses in their fourth quarter 2025 results. Second, banks with large offshore dollar lending operations. For years, banks have lent dollars to foreign corporations and governments, comfortable in the assumption that dollars are always available to borrow if they need them. But what happens when a foreign borrower says, "I need to pay down my dollar loan right now," and the bank needs to find those dollars in a settlement market that has tripled in volume overnight? The bank either has to borrow at penalty rates or liquidate other positions. Either way, profitability collapses. Third, banks that provide dollar liquidity to emerging markets. These institutions are seeing unprecedented demand for dollar swaps and dollar credit lines from corporations and governments in Asia, Latin America, and Eastern Europe. Everyone wants dollars. Everyone wants them now, and the banks are running out of dollars to provide. There is one more element to this that should deeply concern you: the timing. Friday, January 10th, is not a high-stress day in the financial calendar. Markets are open. Settlement systems are functioning normally. There are no holidays, no year-end accounting quirks, no regulatory deadlines. This is just a regular Friday in early January. The fact that banks needed $40 billion in emergency Federal Reserve borrowing on a completely ordinary business day tells you that the stress is not situational. It is structural. The system itself is broken. Compare this to December 31st, when the standing repo facility hit $75 billion. At least there, you could argue it was year-end window dressing, banks temporarily borrowing to make their balance sheets look clean for annual reports. But January 10th? There is no excuse. There is no technical explanation. The only explanation is that banks are running out of dollars, and the Federal Reserve is the only entity that can provide them. $155 billion in emergency liquidity is the invisible proof of collapse. The dollar index on your screen says 97 or 99 or 101, and the financial media says everything is fine. But the Federal Reserve balance sheet says $155 billion in emergency interventions, which says the building is on fire. They're using monetary fire hoses to knock down the flames, so the public does not see the smoke. But the smoke is there. You just need to know where to look. And now you know. The Federal Reserve is not providing this liquidity because the economy is growing and needs more money. They are providing it because the banking system is hemorrhaging and needs transfusions to survive. And the terrifying reality is this: if $155 billion only got us from December 31st to January 10th, how much will be needed to get us from January 10th to January 31st? How much will be needed when the debt ceiling crisis begins? How much will be needed when the first wave of one big beautiful bill spending hits the system and inflation starts accelerating? The answer is more than the Federal Reserve has, more than they can print without destroying confidence entirely. We are approaching the point where the central bank's ability to provide liquidity collides with the market's willingness to believe that liquidity has value. That is the moment when currencies die. While the Federal Reserve fights a desperate rearguard action to keep banks liquid, the real detonator is not monetary policy. It is fiscal policy. The emergency liquidity we just discussed, the $155 billion, is treating the symptom. The disease is the United States government's spending trajectory, and that disease is about to go exponential. The disease has a name: the One Big Beautiful Bill. This legislation, passed in July of 2025 and now being implemented in early 2026, represents the largest fiscal expansion in United States history outside of wartime. And the consequences for the dollar are catastrophic. Let me give you the raw numbers first, and then I will explain what they mean for the dollar and for your wealth. The One Big Beautiful Bill, known by its acronym OBBB, has a 10-year deficit impact of $4.5 trillion. 4.5 trillion. That is not 4.5 trillion in total spending. That is 4.5 trillion in additional deficit. That is the amount by which the national debt will increase beyond what it would have increased anyway. Let me break that down into its components so you understand where this money is going. The tax provisions of OBBB reduce federal revenue by $4.5 trillion over 10 years. This includes extending and expanding the tax cuts from the previous administration, eliminating taxes on tips and overtime, increasing the estate tax exemption, and providing full business expensing for equipment purchases. The spending provisions of OBBB reduce the deficit by $1.1 trillion over 10 years through cuts to Medicaid, food assistance programs, and student loans. When you subtract the spending cuts from the tax cuts, you get a net deficit impact of $3.4 trillion. But when you add in the interest costs on the new debt, the total reaches $4.5 trillion. Now, let us think about what $4.5 trillion over 10 years means on an annual basis. 4.5 trillion divided by 10 equals $450 billion per year in average additional deficit spending. But here is the critical detail. The spending is not evenly distributed. It is front-loaded. The first-year implementation of OBBB, which is 2026, will see deficit increases of approximately $600 billion as tax cuts take effect immediately, but spending cuts phase in slowly. $600 billion in additional deficit spending in a single year means the United States Treasury must find an additional $600 billion in borrowing. Where does that money come from? It comes from selling Treasury bonds. The Treasury must go to the market and find buyers for $600 billion more in bonds than they sold last year. And here is the problem. The buyers are disappearing. For decades, the largest buyers of United States Treasury bonds were foreign central banks, particularly China and Japan. They bought treasuries because they needed a place to park the dollars they earned from exporting goods to the United States. But over the last 3 years, foreign central bank holdings of United States treasuries have been declining. China has reduced its treasury holdings by over $200 billion since 2021. Japan's holdings have stagnated. The traditional buyer base is retreating. So if foreign central banks will not buy the $600 billion in new debt, who will? The answer is the Federal Reserve will have to buy it. The Federal Reserve will have to print new dollars and use those dollars to buy treasury bonds directly from the government. This is the textbook definition of monetizing the debt. This is how currencies die. When a government spends more than it collects in taxes, and when it cannot find willing lenders, and when the central bank steps in to print money and buy the government's debt, the currency loses credibility. Investors start to question whether the dollars they hold will retain purchasing power. They start to sell dollars. They start to demand higher interest rates to compensate for inflation risk. And the currency enters a death spiral. And here's the timing that makes this exponentially worse. The debt ceiling returned on January 2nd, 2026. For those unfamiliar, the debt ceiling is a legal limit on how much money the United States government can borrow. When the debt ceiling is in place, the Treasury cannot issue new bonds beyond the limit. In theory, this should force the government to reduce spending. In practice, what happens is a political standoff where Congress fights over whether to raise the limit, and the Treasury uses accounting gimmicks to keep the government running until the crisis is resolved. We are now in that crisis period. The debt ceiling returned 3 days ago. The Treasury has approximately 6 months of emergency accounting maneuvers available before the government literally runs out of money and defaults on its obligations. Between now and summer, we will see a political battle over raising the debt ceiling. Republicans will demand spending cuts. Democrats will refuse. The government will lurch toward default. Financial markets will panic. And ironically, this panic often strengthens the dollar temporarily, because when investors get scared, they flee to United States treasuries as a safe haven, which increases demand for dollars. But here is what is different this time. The safe haven narrative is breaking. Normally, when there is a debt ceiling crisis, investors buy treasuries because they believe the crisis will be resolved and the United States will never actually default. But that belief is based on confidence in the government's ability to eventually pay its debts? What happens when investors start questioning that ability? What happens when they look at $4.5 trillion in new debt from OBBB and ask, how will this ever be repaid? What happens when they look at $155 billion in emergency Federal Reserve liquidity and ask, is the system even solvent? When that question takes hold, the safe haven trade reverses. Instead of buying dollars during the crisis, investors sell dollars. They move to real assets, gold, real estate, commodities, anything that cannot be printed. And when that shift happens, the dollar does not just weaken. It collapses. The one big, beautiful bill creates a secondary effect that will hammer the dollar in the second half of 2026, inflation acceleration. The spending provisions of OBBB include $325 billion in increased federal spending, primarily on military expansion and immigration enforcement. This money will flow into the economy rapidly. Defense contractors will hire workers. Wages will rise. Those workers will spend their wages on goods and services. Demand will increase. And because supply chains are still fragile from previous disruptions, increased demand will translate directly into higher prices. Multiple forecasts, including projections from Morgan Stanley Research, expect United States inflation to remain elevated above the Federal Reserve's 2% target throughout 2026. Core personal consumption expenditures inflation, the Federal Reserve's preferred measure, is projected to hold at 2.6% by year-end, down only slightly from 2.9% currently. But these projections were made before the full implementation details of OBBB were clear. If fiscal spending runs hotter than expected, if the $600 billion in deficit spending translates into demand-side inflation pressure, we could easily see inflation accelerate back toward 3% or higher. And here is the doom loop. Higher inflation forces the Federal Reserve to keep interest rates higher. Higher interest rates make the government's debt more expensive to service. More expensive debt service increases the deficit. A larger deficit requires more borrowing. More borrowing requires the Federal Reserve to print more money. Printing more money increases inflation. Higher inflation forces rates higher. The spiral accelerates. This is the fiscal detonator. This is the mechanism that will break the dollar in 2026. Not a single policy mistake, not a single crisis, but the mathematical inevitability of a government that spends far more than it earns, borrows from a shrinking pool of lenders, and relies on its central bank to print the difference. That arrangement works until confidence breaks. And confidence is breaking right now. The debt ceiling drama and the one big, beautiful bill fiscal explosion are macro-level events that affect the entire currency. But the real proof that dollar dysfunction has moved from theory to reality is visible at the corporate level. This is where the rubber meets the road. This is where abstract monetary policy becomes concrete business decisions. And what we are seeing in corporate treasury departments across the globe is nothing short of panic. For 30 years, global corporations operated on a philosophy called just-in-time inventory management. The concept is elegant and efficient. You do not stockpile raw materials or cash. You do not tie up capital in warehouses full of components sitting idle. Instead, you order exactly what you need, exactly when you need it, and the supply chain delivers with precision. A factory in Tennessee making automobiles orders semiconductor chips from Taiwan to arrive on Thursday, because Friday is when those chips will be installed in the cars rolling down the assembly line. No wasted storage. No guasti capital. Maximum efficiency. This system has one critical assumption embedded in its foundation. The assumption that you can always get what you need when you need it at a predictable price. For 30 years, that assumption held true for the United States dollar. If you needed to convert euros to dollars to pay a supplier, you could do it instantly at the spot market rate, plus a tiny transaction fee. If you needed to wire dollars from New York to Singapore, the transfer would clear in hours. The dollar was the ultimate just-in-time currency. It was always there when you needed it. That assumption died last week. And when it died, just-in-time died with it. We have received confirmed reports from supply chain sources that Apple Inc. has executed emergency dollar hedging transactions worth over $5 billion to secure currency coverage for the next 9 months of component purchases. Let me explain what this means in practical terms. Apple manufactures most of its products in China and Taiwan. It pays suppliers in United States dollars. Under normal operations, Apple would simply convert whatever currency it has on hand into dollars as needed throughout the year. But Apple's Treasury Department is no longer comfortable relying on the spot market. They have seen the 15% premiums in Hong Kong. They have seen the settlement surge. And they have made a decision. Lock in dollar availability now, regardless of cost, to ensure production continuity. $5 billion in forward currency contracts means Apple is paying today to guarantee they can obtain dollars at predetermined rates over the next 9 months. They are paying insurance premiums, essentially, against the risk that dollars become unavailable or prohibitively expensive. This is not speculation. This is not financial engineering. This is a corporation with a $600 billion supply chain saying, we no longer trust that the currency markets will function normally, so we are paying to eliminate that risk. Think about the implications. Apple has a Treasury Department staffed with some of the most sophisticated financial professionals in the world. They have access to real-time market data. They have relationships with every major bank. If Apple is hedging 9 months of dollar exposure in a single emergency transaction, what do they see that the public does not see? They see the fracture. They see the settlement stress. And they have concluded that the risk of dollar unavailability is greater than the cost of hedging. Taiwan's semiconductor manufacturing company, known as TSMC, is the world's largest contract manufacturer of advanced semiconductor chips. Every major technology company depends on TSMC. Apple, NVIDIA, AMD, Qualcomm. The entire artificial intelligence revolution runs on TSMC chips. And TSMC has a dollar problem. TSMC pays its workers in Taiwan dollars, but sells its chips in United States dollars. Under normal circumstances, this creates a natural hedge. Revenue in dollars, expenses in Taiwan dollars. Manage the exchange rate risk through routine treasury operations. But the current situation is not normal. TSMC is reportedly experiencing unprecedented demand from customers requesting immediate delivery and immediate dollar payment, while simultaneously facing elevated costs to convert those dollar revenues back into Taiwan dollars to pay local expenses. Sources within TSMC's finance division indicate the company has shifted from a balanced currency posture to a dollar-long posture, meaning they're intentionally holding more dollars than they operationally need as a precaution against future dollar scarcity. This is expensive. Holding idle dollars means those funds are not being used for capital investment or shareholder returns. But TSMC has apparently decided that the cost of holding excess dollars is less than the risk of needing dollars and not being able to obtain them. Why would TSMC fear dollar scarcity? Because their customers are panicking. Because Apple and NVIDIA and every other technology giant is simultaneously trying to secure dollar liquidity. Because everyone is trying to front-run the same crisis. And when everyone tries to buy dollars at once, the price spikes and availability drops. In the automotive sector, we're seeing a different form of panic, project cancellations. Major automakers with multi-billion-dollar electrification programs are reportedly freezing capital expenditures on new factories and battery production facilities. Why? Because those projects require long-term dollar financing. When you build a $5 billion battery factory, you typically borrow the money through bond issuance or bank loans denominated in dollars. But lenders are becoming reluctant to provide long-term dollar financing at fixed rates because they fear the dollar's instability. One major European automaker, which I cannot name due to source protection, has reportedly shelved plans for a battery factory in the United States that would have cost $4 billion. The official reason given was permitting delays. The real reason, according to sources close to the decision, was an inability to secure dollar construction financing at acceptable interest rates. Banks were offering financing, but at rates 3 percentage points higher than the automaker had budgeted, which made the project economically unviable. This is the real-world consequence of dollar instability. Not just currency traders losing money on forex positions, but actual factories not being built, actual jobs not being created, actual economic growth not happening, because the foundation of the system, which is a stable, reliable dollar, has cracked. Perhaps most alarmingly, we are receiving reports of stress in dollar settlement for oil transactions. Oil has been priced and traded in United States dollars for 70 years. Every barrel of oil exported by Saudi Arabia, every tanker of natural gas shipped from Qatar, every futures contract traded on NYMEX, all denominated in dollars. This system, known as the petrodollar system, has been the bedrock of dollar dominance for half a century. But that system requires willing participants. It requires oil exporters to accept dollars in payment. And increasingly, we are seeing oil exporters demand alternatives. Not because they prefer euros or yuan for philosophical reasons, but because they fear the dollars they receive today might be worth significantly less by the time they want to spend them. Multiple reports from Middle Eastern trading desks indicate that certain oil transactions are now settling with gold clauses or inflation-adjusted pricing, effectively removing the dollar as the stable unit of account. When oil trades with a gold clause, it means the seller is saying, "I will accept dollars," but the number of dollars is tied to the gold price at the time of delivery. If gold rises 10% between contract signing and delivery, the buyer must pay 10% more dollars. This protects the seller from dollar devaluation, but it also fundamentally undermines the dollar's role as the pricing unit for global energy. Once you admit that the dollar is unstable and needs to be hedged, you have admitted that the dollar is no longer a reliable store of value. And once that admission takes hold in the oil market, the petrodollar system begins to disintegrate. Connect all of these data points, and a clear picture emerges. Apple hedging $5 billion in dollar exposure. TSMC hoarding excess dollar reserves. European automakers canceling projects due to unaffordable dollar financing costs. Oil transactions moving to gold-linked settlement. These are not isolated incidents. These are symptoms of a system-wide loss of confidence in the dollar's stability and availability. Corporate treasurers are not economists debating monetary theory. They are pragmatists managing real businesses with real cash flows. When they make decisions to spend hundreds of millions or billions of dollars on emergency currency hedging, they're not being paranoid. They're being prudent. They see the settlement surges. They see the Federal Reserve bailouts. They see the one big, beautiful bill fiscal explosion. And they are taking action to protect their companies from the collapse they see coming. The shift from just-in-time to just-in-case is the corporate world's vote of no confidence in dollar stability. And when the corporate world loses confidence, the currency is already in the process of dying. The official announcement comes later, but the death has already occurred. We are observing the final wealth transfer. 40 years' wealth was stolen from physical holders by paper manipulators. They used leverage to suppress reality and hide real value. But in the next 36 hours, gravity turns on. The buffers are gone. No more physical buffer. No more liquidity buffer. No more inventory buffer. What remains is only the naked truth of supply and demand. So this is my final message to you before the new year. Do not look at red candles and feel fear. Look at them and feel pity. Pity for people selling real assets for paper currency that is being printed by the billions to cover banking bankruptcy. You are on the right side of the trade. You hold assets that cannot be printed, cannot be hacked, and cannot be defaulted on. The era of paper dollars ends tonight. The era of strategic real assets begins Monday. The 36-hour countdown is running. Hold tight, stay safe, and prepare for the revaluation of your lifetime. This is Marcus Kane from the Market Reaper. Warning delivered. Timeline set. I will see you on the other side of the gap. Like, subscribe, and share this video. The world needs to know what is happening.